Hi everyone, what are you doing? Hope you're doing well. Welcome to our video. Today I want to talk about risk allocation and how the stock market can crash 50% or double in the next 12 months. Why I'm doing this video? This is another episode for my playlist, high value content playlist, macroeconomics related, and a few days ago, it's probably been 1 week, I was having dinner with a group of friends and the stock market right now is having a small correction. Cryptos were also falling, and a friend of mine, just remember he doesn't have a financial background, was asking me why was the stock market crashing or why were cryptocurrencies crashing, and I asked him the question back, so why do you think the stocks are falling or cryptos are falling? And he answered me, right now we are in December. Well, probably a lot of people right now want to cash out a bit because they want to buy Christmas gifts, and initially I laughed, but that's actually a pretty good answer. And while I cannot say for sure that is the reason why the market is falling or not, because nobody in the short term can really justify with 100% certainty why something is going up or down, I decided to make a video because the past week, it's been a week, but I don't know when you'll be watching this video, Jerome Powell was appointed or is going to continue as the chair of the Federal Reserve, which is the central bank from the United States. And I decided to make a video why interest rates matter. And right now we are living in a testing period, if you want to say that. But without any further ado, it's time for me to start coming back to my drawing capabilities. And I'm sorry for my handwriting, but this is a really nice concept for you to grasp, and hopefully you can understand what I'm writing here. So this is going to be the y-axis for returns on your investment or your asset, and this line here, actually let me try to make it a bit more horizontal, is going to be the risk. So we're going to have here 0, and I can make a better 0, sorry, I'm not well known for my handwriting, everyone hates my handwriting, but you'll have to manage with me today, because I think it's easier for you to grasp these concepts this way. And I'm just going to draw here a traditional line. It is slowly increasing, and we can have here, let's call it the risk-free rate. I'm just typing here risk-free rate. And what is this risk-free rate? Essentially it's treasury bonds from treasuries. Okay, so just imagine between having dollars in your bank account or having, let's say, a treasury bonds from 10 years, 20 years, 30 years, it's essentially the same. You're just betting that the US government is going to pay back that loan. The dollar also ascends on that principle in a way. So if you believe in dollars, you basically believe in the US economy. So you can see here the amount of risk. The amount of risk is kind of low, but also your return, it's going to be lower than other asset classes here at the end of this line. But let me just erase this. Probably I can, yes, choose something so slower, okay, smaller. So the next thing we are going to have here are going to be high grade, oops, right, I'm sorry for my handwriting, bonds. So just as a bond versus a stock owner, you have priority because you've been essentially lending money to a specific entity. Doesn't really matter, but most of you are familiar with the next one, which is going to be, let's call it quality stocks. So basically, if you watch my videos, you sometimes see me buy companies like, let's say, Google. You see me buy companies like Apple. So these are really high quality companies that are probably going to stick around for the next year. So you want this, and you will have a higher return than, let's say, a treasury or a high grade bond. But of course, you are also having a higher risk than before. But that's essentially the price you pay. Then we can have here aggressive stocks. So you see a lot of that here on YouTube. This is going to be some high growth stocks, so then again it's more riskier, but it's associated with a higher return. It doesn't necessarily need to be that way, but this is just for you to get the picture how the risk allocation is going so far. So we can have stuff here like private equity, and another thing here, let's put here crypto, because you are also familiar with this. Okay, you will have higher returns, let's say, for crypto, but of course you're also taking a lot more risk, essentially. And yeah, this is how normally things are supposed to work. But since 2008 and now with the COVID, the pandemic, interest rates, which basically define how much you get for these treasuries here, are at all-time lows. Here in some European countries they are actually negative, but I'm not going to draw them here. In the US they are not, and since I'm mostly invested on US equities, that's what I'm going to use for the purpose of this video. Actually, let me change this for the blue line. So you can see here that right now, actually I'm not the best at drawing, but you get the picture. So for the same thing, for the same treasuries, you have the same risk, but you are having a substantially lower return than before. You can see it clearly here. And so people are kind of forced right now to invest into more speculative assets to try to get the same returns that they had previously. So essentially, actually, let me erase this. Okay, so just imagine before, if you invested in quality stocks, you would have this amount of return, but nowadays you probably need to invest, let's say, in cryptocurrencies, and sorry, this is such a poorly drawn, to get the same amount of return. And this is not also the only important factor, because I'm just here oversimplifying everything. And you also know that in my playlist, in this playlist, I talk about long-term debt cycles, I talk about inflation. And why is this important? Well, let's suppose inflation is at this level, and let's call it here 2% or 3%. Sorry, 3% and 3%. So basically, essentially, if you're paying for treasuries, you're losing purchasing power year over year, so this might not be a good option. If you're here with high-grade bonds, also you're getting this lower than inflation, so you're technically losing money. Only after you need to basically push yourself in the risk level to get the same amount of returns, or at least try to beat inflation. Also, I forgot here to put between maybe aggressive stocks and private equity. Let's put here high. Oh my god, my handwriting. High yield bonds. Oh my god, I'm so sorry. High yield bonds. I'm also not writing on the table. This because I just got reminded. I reminded myself that of the Evergrande, you know, the real estate company in China that's going default, or if the government is going to bail them out or not. We don't know that yet at the time of recording this video. So yeah, you can put that in that perspective, in that scale. Should be more or less between aggressive stocks and private equity and before cryptocurrencies. And yeah, but back to the picture. So if inflation is 3%, you probably need to get invest into more aggressive assets in order for you to at least not lose purchasing power over the years. But of course, this is highly dependent on these treasuries, because this is considered. Actually, let me choose here this. This treasuries is considered the risk-free rate. So just imagine that, okay, right now we are having super high inflation, and the central bank needs to do something to fight this. Well, guess what's going to happen? Interest rates are going to rise. So at the same time, okay, debt will be unsustainable, but that's a topic for another video. Actually, I already mentioned in previous videos of this playlist, but you can say here, okay, maybe treasuries will have now this return here. So why would you invest, let's say, in quality stocks, in private equities, in cryptos, if you could have this amount of return that's clearly beats inflation level? Why would you be risking it all into more speculative, riskier assets when you can just have it into treasury bills or maybe high grade bonds? So that's what happens in this kind of situation. This is why the market can crash 50% simply by if interest rates rise. So essentially, people will be moving their assets for safer, let's put it safer. Treasuries or high grade bonds, and so valuations will need to be adapted because this might be as have the opposite effect. So if they don't change interest rates, or if interest rates even go lower or negative, well, comparatively stocks can be way undervalued right now, because you will be essentially losing money with all of these safer assets. And that's what I just really wanted to talk about in this video. I'm sorry for my handwriting. This is how I organize stuff in my head. And also, if you have any questions about this, just leave them down in the comments. I always like to engage with the comments whenever I get them. If you have any questions, I hope you understand this. Maybe this wasn't super organized like some of my videos, but it is an important concept to grasp. And the other day when I was talking with my friend, I had the idea to make a video about this, and hopefully maybe you never thought about this, maybe you already knew this. The goal here is that I try to add some value to you. If you don't like, you can always hit the dislike button. I don't think YouTube has it anymore, but if I have the option to have the dislike button, I'll leave it there so that I can know if the content is good or not. Having that said, thank you for watching, and I'll see you in the next video. Bye.